Now, we are going to start off today's presentation with a question that came in via email. And this is from William. And earlier this afternoon, William emailed me and he said, I'm trading upwards of 30 stocks each month. Am I better off trading multiple contracts of half, 15 or so, rather than one contract of all 30? Now, he didn't mention which strategy he was doing. I can assume covered calls based on the question, 30 stocks, and I'm trading one or two contracts on all 30. Should I maybe go to 2 or 3 contracts on 15 stocks instead? What are the pros and cons of diversification? What are the benefits and what are the sort of misses that we come across? Oh, sorry, folks. There we go. Now, why diversification? Well, the pros is it mutes the surprise losses, of course, on 1 or 2 choice stocks. I've got 30 positions open. I had a stock position that opened up 10% down today, recovered by the end of the day and was only down 5%. That was Trex. It was in the Married Put portfolio, so I think that position is already bulletproof. Would have liked to take advantage of the decrease using some of the income methods in the blueprint, but I just let it sit to see how it played out, and it made back half of it. But if I've got 30 positions and one stock drops 10%, well, that's probably not affecting my portfolio by maybe more than 1-2% at most. So that's a benefit. Now, of course, the performance should mirror the general market. If I'm diversified into 30, 40, or 50 stocks, I probably have multiple sectors and multiple industries. So although some are weak at times and some are strong at times, it should balance out, and I should be meeting or exceeding just the return on SPX or maybe NDX, depending on which stocks I'm looking at. If I'm more heavy into tech or if I'm more heavy into broad stocks, more heavy into the Dow, well, I should be able to meet that performance and maybe exceed the general index performance for, say, SPX or just buying SPY, QQQ, or IWM, in theory. The cons, of course, the reverse. Surprise gains that you weren't expecting are muted. I suddenly have a stock that didn't have earnings come out in my 30, 40, or 50 diversified stock portfolio. Covered calls, what have you. Of course, that would be muted anyway because of the capped gain. But now that one that moves up 10 to 15% on positive news that suddenly came out might only increase my portfolio by 1 or 2%. It's muted due to what the rest of the portfolio is doing. Will it generally outperform the general market? Well, we assume it will with diversification across different industries and sectors. But if I'm heavier or 2 or 3 of the positions I'm in are higher priced and that looks like more of my portfolio, it represents more of my portfolio, I should say, well, I might not meet or beat the general market conditions of just putting $40,000 or $50,000 into SPY and doing covered calls on that. I'm not suggesting that by any stretch of the imagination, but that is a con of the diversification depending on how you're diversified, where these 30 stocks are in the industries and sectors as well. And of course, I've got 30, 40 positions. If you're having difficulties with tracking the stocks and options, trades on multiple securities. So I'm not only tracking 30 stocks, I'm tracking 30 options against those stocks, whether I'm doing a covered call, even a married put perhaps. So maybe that's a little bit more difficult and I'm spending more time in the news on each stock, researching and analyzing each stock, reviewing the sector and industry that I'm in. Maybe it's too time consuming for me. Of course, that's why the Power Options portfolio tool is so useful to help you break down and easily view the linked trades, covered calls, married puts, collars on 20, 30, 40 stocks that you might have trading at the time. General thoughts, though, on this approach for William. I will usually only have about half of that, maybe 15 to 20 positions open at a time. Truly, though, that's based on market conditions. I allocate my portfolio. Of course, you guys have heard me say this time and time again, but based on what I like to do, strategies that I'm comfortable with, at any given time, I'll have about 5 to 6 married puts open following the radioactive trading techniques discussed in the blueprint. That represents about 45 to 55% of my portfolio. It is cash intensive because I'm buying the stock and buying the put option to protect it to single digit risks, then using the income methods. I might have 1 or 2 standard collar positions open. What's a standard collar? Well, instead of a married put, buying a far out put that we prefer with the radioactive trading techniques and maybe selling near-term calls against it. The standard collar is I'll buy a stock at, say, 50. I'll sell maybe the 52, 52.5 strike for 1 month or 2 weeks out in time, and I might buy the 47.5 or the 45 put. Small net credit might give a 1.5% max return over a 2-week period, 3-week period, but a controlled risk of only 3, maybe 4% if it falls below that put strike price. These are not long-term holds. It's like a covered call position for me, but I prefer the safety of the standard collar over a slightly in the money or deep in the money covered call. And that's 15% of the portfolio because although it's only 2 positions, I have to buy the stock, so it's capital intensive once again. 3 to 4 bull put credit spreads following discussions that we've had. That represents between 10 to 15% of the total portfolio. 2 to 3 calendar spreads. Diagonal calendar spreads, poor man's covered call might be calendar call spreads, might be calendar put spreads based on the market conditions. And that represents about 10% of the portfolio. I like to have a strangle open on SPY, maybe QQQ or IWM, just holding the strangle and managing it up and down as the markets move. Consistently on it's at a little bit of extra protection for down markets, but also a little bit of extra profit in strong markets. If market conditions are right, when the VIX is at a lower end, I might have 1 calls open on the VIX. Now, I don't mean 1 call. Let me be clear on that. I don't mean 1 contract of a VIX call. I just have 1 position that might be 8 contracts, 7 contracts on VIX calls. Okay, and that's about 2 to 3% of the portfolio. And then, of course, hey, we all like to play little lottery tickets. I might have 2 to 3, maybe 4 long calls or long puts open on stocks that popped up in the news, stocks that I think are poised for some kind of breakout, or I've seen a recent Bollinger Band breakout based on the default criterion power options. That's 2 to 3% as well. Now, on the high end, if I went to the high end of each allocation and each position, that would be 20 total positions, or 104% of the portfolio. And that's why the bull put credit spreads and the calendar spreads, the calendar spreads might be 7 to 10%, bull puts might be 10 to 15. If I go to 6 or 7 married puts, perhaps, then I'm going to lower the percentage allocation in those other 2 strategies, naturally. So I'll never have 104% invested. You can't do that, obviously. And on the low end, I'd have 15 positions open, which represent about 86% of the total portfolio. And in uncertain or deeply adverse market conditions, that could drop drastically. So, for example, around the time frame of January into February of 2020, when the bearish sell signals were going off and the world was going crazy, I probably only had 25 to 30% of my total portfolio into some different positions. Once the market started to turn, we started getting the buy signals on the power options market sentiment tool on around March 20th. Really, for me, it was April 1st or April 3rd when I felt the strongest in 2020. I went back into more bullish positions, bought long lead calls, entered some new married puts, opened 4 or 5 collars, as a matter of fact, started trading more calendar spreads and the bull put credit spreads. And, I was back up to this 20 positions with about 95, 96% of what I've set aside to trade in options in my portfolio. So this also comes down to strategy selection, personal risk threshold, and ability to track and manage your positions. Are 30 positions or options trades too many? And again, that comes more down to the individual. We have customers that do about 20 to 30 trades per week, some zero data expiration, weekly covered calls, weekly spreads, and other strategies. I've seen some portfolios on coaching sessions with power options that have close to 100 positions. I don't know if they're all real, but I can think of 2 or 3 power options customers off the top of my head where I've seen those, and they look like they're actual managed trades that have been continued to be rolled, adjusted, and managed. And I do have customers, power options, we have talked to customers that trade only 2 to 3 positions per month. And I have talked to radioactive trading blueprint owners who only trade maybe 3, maybe 4 stocks out of the entire year. And they're just doing the income methods and applying it on the 4 stocks that they have in their portfolio. And they're rolling out the put further out in time when they get to 60 to 70 to 90 days to expirations. They're always out maybe 1.5 years to 2 years on that put option and still just continue to trade just those 4 positions. And that's it. Personal preference, time you have to allocate, and of course, the tools you're using. And that's why the Power Options portfolio tools, I feel, are very powerful, whether you're trading multiple strategies, multiple securities in those individual strategies, or if you're just trading 3, 4, or 5 positions over the course of the year. So some final thoughts, William. If you're asking if you're trading too many stocks, well, you might not be meeting your goals. You're too diversified and you're falling into the con section of the pros and cons of diversification. Maybe you feel you're spending too much time with analysis and management, going through, trying to read the different reports, trying to track when each earnings are, trying to see what's in the news, going through the news in each individual stock through your broker or through a finance page, or you're overwhelmed with tracking the multiple positions, trying to follow multiple sectors, grab the news from multiple sectors and industries. You're asking the question for a specific reason. I want you to ask yourself, why did I ask this question to begin with? Other than to get Mike's thoughts on it or Ernie's thoughts on it, what prompted you individually to ask that question? It might be one of these 3 things. And in that case, I think if the answer to any of these questions are yes, I'm not meeting my goals, my apologies, I'm too diversified. I'm spending too much time with analysis and management, I'm overwhelmed with tracking these positions, then absolutely. I'd want to scale that back, maybe drop it down to 20, drop it down to 15 positions. But test out the lower range first. Go back over your last 2 months of trades. Which stocks perform the best for your strategy? And then analyze, looking at the chart or using some of the historical data on power options, was there something common on those stocks that seemed to outperform the others? Was it a common pattern in the stock chart, a recent breakout in a technical, Bollinger Band, MACD, something along those lines? Or do the stocks that seem to perform better all seem to have a higher earnings per share growth percentage? Something along those lines. Was there something that stands out on the stocks that performed for what your strategy needed? And then what we might want to do is take those 10, take those 15 stocks that seem similar that outperformed, and analyze what the gain or loss might have been on just those better securities over the past 2, 3, or 6 months. Did you outperform your actual trades? If the answer is yes, then maybe now we've got some fine tuning that we can do on the criteria and power options for searching for the positions. Maybe it was something as simple as just the return. Those that offered a slightly higher return that were a little bit more volatile seem to perform better in your portfolio. And maybe that's what we can adjust in the power option search tool. And of course, we can handle that over email, or we can handle that over a coaching session as well. So those are my thoughts, William, on the positions. Okay. Is 30 too much? I've seen investors trade 3 times as much. At least that's what they have tracking in their portfolio. I've seen investors using power options tools do that many trades per week of individual positions, combination of naked puts, spreads, covered calls, buy puts, those kind of things. So it comes down to you. But first, ask yourself, why was I prompted to ask this question? What is in my portfolio? What is happening with my trades that prompted me to say, maybe this is too much? Go back, test out if you had just done 10 or 15 positions that seem like they performed the best. What stood out about those positions fundamentally or technically on the securities or with the option premium or the option prices? Was there anything that seems to stand out? Then we can talk about fine-tuning your results and trying to minimize this down if that meets your needs. If not, maybe you're still okay using 30 positions, tracking them in the power options portfolio, setting the alerts based on your needs, and we'll still be able to achieve the goals that you want and, of course, help you minimize that research time and tracking the multiple positions in multiple sectors and industries.